Palantir Technologies entered the public markets through its initial public offering in September of 2020, marking a major milestone in the company's evolution from a private data analytics firm into a publicly traded enterprise software powerhouse. During that debut, the company offered its first allocation of public shares to institutional investors and the broader investing public at a price of $7.50 per share. By the close of its very first trading session, enthusiasm from the market pushed the stock to finish at $9.50 per share, signaling immediate confidence in Palantir's long-term vision and technological capabilities on the National Association of Securities Dealers Automated Quotations Exchange. Since that opening chapter, Palantir's stock performance has been nothing short of extraordinary. Today, shares are trading at approximately $179 per share. When measured against the closing price from the day of its initial public offering, this represents a gain of more than 1,790%. That kind of appreciation places Palantir among the most dramatic long-term winners in the modern technology sector. With a run like that, it is natural for investors to start questioning whether the stock still represents a compelling opportunity, particularly when discussions around a potential stock split begin to surface. A stock split typically comes into play when a company's share price climbs to a level that becomes either practically difficult or psychologically intimidating for a broad group of investors. In these situations, management may choose to divide existing shares into a larger number of shares, effectively reducing the price per share while leaving the overall value of the company unchanged. Importantly, this type of action does not alter the company's underlying fundamentals, nor does it change the percentage ownership held by each investor. In recent years, stock splits have also gained a renewed attention because they often make shares appear more accessible and can reignite investor enthusiasm, sometimes leading to renewed bullish momentum in the market. That said, while Palantir's valuation has surged at an eye-catching pace over recent years, its current share price alone does not necessarily demand a split. Compared to other high-profile technology names that have pursued splits at much higher price levels, Palantir still sits within a range that many investors can reasonably access. Because of that, it appears unlikely that the company would move forward with a stock split unless shares climb well beyond their current valuation territory. Any such decision would likely be driven by sustained price appreciation rather than short-term market excitement. This distinction is critical for investors evaluating whether now is the right time to buy. Those who believe Palantir's strong revenue expansion, improving profitability, and growing influence in artificial intelligence will continue driving the stock higher over the long run may view current prices as a reasonable entry point. From that perspective, purchasing shares today could make sense as part of a long-term investment strategy. However, buying the stock solely in anticipation of an imminent stock split, with the hope that it alone will push valuation significantly higher, is a much weaker thesis and carries additional risk. Recently, shares of Palantir Technologies have moved modestly higher over the past month, extending what has already been a remarkable year for the market's most prominent artificial intelligence-focused company. Investor attention remains elevated, largely due to the rapid adoption of Palantir's artificial intelligence platform, which has become a centerpiece of the company's growth narrative. This platform has positioned Palantir as a pure-play exposure to enterprise-level artificial intelligence adoption, attracting both retail and institutional capital. To better understand near-term expectations, Palantir Technologies was analyzed using an artificial intelligence-driven price forecasting system powered by OpenAI's generative pre-trained transformer. Rather than chasing an attention-grabbing long-term valuation estimate, the purpose of this analysis was to evaluate how a data-focused model views the stock's behavior over the next 60 days. The system incorporated recent price movements along with a selective group of technical indicators to generate a 2-month outlook. At the time the analysis was conducted, Palantir was trading at $184 per share. For the period spanning from December 16th through February 10th, the model produced a base scenario that pointed to an average predicted price of $187 per share. This outlook implied a modest upward movement over the coming month, favoring gradual gains rather than explosive upside or a sharp correction. In other words, the model suggested a steady climb rather than dramatic volatility. The technical signals supporting this outlook were notably constructive. Both the moving average convergence divergence and the relative strength index index tilted positive, indicating that current momentum remains intact. According to the model, given existing volatility conditions, the most likely path forward is a slow incremental grind higher from current levels instead of a sudden reset. At the same time, broader artificial intelligence valuation scenarios suggest that Palantir Technologies could eventually reach a range between $180 and $250. That wide range underscores just how much long-term optimism is already embedded into the stock's current pricing. At the heart of Palantir's meteoric rise and a major contributor to the artificial intelligence model's bullish lean is the commercial success of its artificial intelligence platform. This offering is designed to help enterprises rapidly integrate generative artificial intelligence models directly into their operational workflows. Adoption has been accelerating, with recent updates highlighting a sharp increase in commercial customers and rising contract values. This momentum is especially significant because it marks a shift away from Palantir's historical dependence on government contracts, which, while powerful and prestigious, have sometimes been inconsistent in timing and scale. This expansion into the commercial sector is a pivotal step in Palantir's transformation from a specialized analytics provider into a full-fledged enterprise software leader. By broadening its customer base and deepening relationships with private sector clients, the company is building a more diversified and scalable revenue foundation. However, the artificial intelligence model's restrained short-term outlook also reflects the reality of Palantir's elevated valuation. Trading at high multiples relative to forward sales and earnings expectations, the stock has already priced in several years of exceptional execution. That valuation acts as a form of natural resistance. Each incremental percentage gain becomes harder to achieve as expectations rise. The market has demonstrated limited tolerance for missteps, whether in earnings delivery or customer growth. As a result, even a relatively minor disappointment could trigger a sharp pullback, reinforcing the importance of consistent execution at these levels. Despite these risks, the combination of positive readings from the moving average convergence divergence and the relative strength index suggests that bullish momentum has not yet been exhausted. A favorable convergence in the moving average convergence divergence points to strengthening buying pressure, while a relative strength index that remains below the overbought threshold of 70 indicates there is still room for the stock to advance without immediately sparking widespread selling. This technical environment aligns closely with the model's expectation of a calm but persistent upward trend. Beyond technical indicators, Palantir's entrenched position within government and defense agencies through its Gotham platform provides a degree of stability that few other artificial intelligence-focused companies can replicate. This dependable revenue stream serves as a strong backbone, while the company's Foundry and artificial intelligence platform offerings pursue aggressive commercial expansion. Palantir's ability to address the complex data analysis needs of both governments and multinational corporations places it in a commanding role within the rapidly expanding data and artificial intelligence ecosystem. From a Wall Street perspective, sentiment remains cautiously constructive. Across major research platforms, analysts currently maintain a hold consensus rating, with 12-month price targets clustering between the mid-$180 range and the mid-$190 range. Some of the more optimistic forecasts envision upside into the high $200 territory. Even the median targets suggest approximately 5% to 10% upside from current levels, closely mirroring the artificial intelligence model's expectation of a slow but positive trend. Taken together, the artificial intelligence-driven outlook should be viewed as a short-term temperature check rather than a definitive judgment. It offers insight into how quickly the market may be willing to reward Palantir with higher valuation multiples following periods of consolidation. It does not suggest that Palantir's artificial intelligence-driven expansion has run its course, nor does it dismiss the company's long-term growth narrative. Instead, it highlights a stock that remains powerful, highly valued, and closely watched as the artificial intelligence trade continues to evolve. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.